I'm going to show you guys how I can take payouts like this twice a month using money that's not even mine. And the best part is you basically need nothing to start. This is part 1 of a 3-video series showcasing my entire strategy, everything I know about trading to be consistently profitable. If you want a chance to run some free funded accounts, guys, make sure you're subscribed. Other than that, let's get right into it. All right, guys, let's get right into it. This is the Master Trader Playbook. This is day 1. Today, all we're going to be talking about, guys, is going to be theory, right? The theory behind my strategy, which I think is incredibly important to know why it works, how it works before you can learn all the analysis and the setups. If y'all have any questions, by the way, and anything I discuss here, whether it's charting platforms, brokers, prop firms, whatever it is, ask it down in the comments below and I'll get back to you guys as soon as I can. So when it comes to trading, right, what exactly am I looking at? So I'm honestly only trading futures here intraday. I do options longer term, but for day trading, which is my main source of income, I'm doing futures, which is the simplest market to actually get into in my opinion, right? What matters most about this is that they're leveraged, which means we can get a better bang for our buck when we trade them, which is why I say you don't need much or anything at all with prop firms these days to get started. So this right here is what a future is. And to be honest with you guys, what a future contract is doesn't really matter, right? All that matters is that we make money when it goes up or down, and it's a leveraged instrument. I'm going to show you how the pricing actually works here in a little bit. So when I say I'm going long, I'm looking to buy the asset and sell at a higher price. When I say I'm going short, I'm borrowing the asset, right? Selling it right away and looking to buy it back and return it at a lower price, pocketing the difference. What's important about long and short is that they're the same thing. You press the same button. It's not any more complicated. One is just the same as the other one. I honestly prefer shorting most of the time. Options are basically the same thing. The definition is a little bit tricky and confusing, but it doesn't really matter at the end of the day, right? When I say I'm going for a call, I'm going long. When I say I'm going for a put, I'm going short. Here are the pros and cons of options and futures. Y'all can kind of get your head around what you want to trade, right? So futures, right, there's no PDT, meaning you can trade them, day trade them as many times as you want, 23 hours a day, 6 days a week. The spread between them, we're going to get a lot into this. It's consistent. There's no Greeks. We're going to get into that as well, which is confusing shit about options. And it's simple, right? Options, there's a lower margin for swinging them. I mean, you can actually hold options in a longer time frame with less amount of capital in your account, but that's okay because we're talking about intraday day trading here, right? 23 hours a day, 6 days a week. You can only trade them Monday through Friday at 9:30 to 4 p.m. EST. They have crazy bid-ask spreads sometimes. We'll get into that. Confusing Greeks. We'll get into that as well, guys. That's how you pick the contract. Expiration with the volatility. It gets super confusing, which is why we're going to be focusing on futures, the simplest market to trade. And usually futures are all you need. People who switch from options to futures usually never go back to options and stick with futures. So if you're trading both, which I do, right, I'm going to tell you when to do one versus the other. So for options, if there's a clear-cut market direction, right, if the IV, I'll show you how to get that, is over 70%, and if it's a tight spread. Don't get too out if you don't understand what I'm talking about right now. It'll all make more sense in a little bit. I'm kind of break down all the theory behind what we're trading so everything makes sense to you guys, right? But why we're focused on futures, right, is because the strategy is going to stay the same no matter which one you're trading. You can even do crypto, forex, whatever it is, same strat. The differences with options is it makes it more complicated. You need to analyze the option chain, which is very confusing, especially for beginners, right? So what I do is I use futures to make money and options to multiply it long term. This is kind of theory and thesis I want to get behind you guys as well. So the two future contracts I trade, I only trade these two pairs. That is it, right? ES, which is the future contract of the S&P 500 or SPY, and NQ, which is the future contract of the QQQ. Again, they're all super big, super volatile, a lot of volume. And I trade the New York session, which is why I only trade these two. They present me plenty of opportunities. So keeping it simple, that's all we're trading. I'm going to talk to y'all about the leverage and the pricing of these actual contracts, right? So an ES contract, so every point the ES moves on a graph, you'll make $50 per contract, right? And then if you buy one ES at 5,000, sell it at 5,010, you make $500, right? The margin requirement for it is a little bit tricky because different brokers have different margin requirements, meaning that, trader amp, it's around $500 per contract. So if you want leverage to one ES contract, you only need $500. Thinkorswim, the broker I use, is around $17K per contract, which is pretty crazy. Which is why if you're trading futures, I highly recommend you use a futures broker, right? Like these I mentioned here, or a prop firm, which is better for most people. Now the leverage with NQ is a little bit different, right? So every dollar NQ moves, you make $20 per contract, right? So if you buy one NQ at 20,000, so if you buy one NQ at 20,000 and you sell one NQ at 20,010, you make around $200 on that move. Now the margin requirements is the same, right? So all the futures broker will have better margin requirements, around $1,000 per contract. And Thinkorswim, the one I use, will have a much higher margin requirement. I only use this broker because it lets me do options and futures, which I utilize both of them. So why do I do only the ES and NQ, right? So you need to understand two things that will kind of whole theory behind ES and NQ, right? The simplicity and market session. So super simple, right? Simplicity means, right, you should only be picking 1 of 3 tickers, instruments, whatever it is to trade a day. Only, that is it, right? If you analyze 10 different tickers, it'll cause you to go crazy. You'll be confused. You'll miss out on shit. You'll overtrade. It's not something you should be doing, right? Each ticker has its own personality. So that's why you need to learn how one or three of them work like the back of your hand. And ES and NQ personally give me more opportunity than I really need every single day. So the market session is also super important, right? So I trade the New York Open, and ES and NQ have the highest volume, highest volatility, highest transaction amount at this time. So that's why I trade both of them, because I'm looking for quick moves. Other sessions like the Asian session and London session are also great with ES and NQ, right? But there's different things in different time frames you have to look to trade. So if you're trading a time frame where there's not much activity on the New York session, you probably don't want to be trading ES or NQ. You probably want to look at gold or something else in those same lines. So the theory behind my trading is very, very simple. I use the auction theory, and this is what I use to predict intraday movements, and it's based on level 2 data. Then I also use smart money concepts to find valuable price levels and areas of interest, as well as volume by price analysis. So the auction theory is basically a theory that says the stock market is just like any other market, right? It's like the real estate market, car market, whatever it is. It's an auction, right? Every market is basically an auction. So to understand the auction theory, you have to understand the different order types, you have to understand volume by price analysis, and you have to understand aggressive versus passive participants in the stock market. So to explain it a little bit better, right? The market will move up until the last buyer buys and move down until the last seller sells. So as an example, let's say Apple Store is selling an iPhone for $1,000 and they're quickly selling out, right? Apple then decides to raise the price up to $1,500 and people still buy it, but they don't sell out, right? So they still have a bunch of inventory left over. People stop buying, right, at a given point. So Apple must move the price back down to $1,000, so they start buying again. If people stop buying at $1,000, they'll drop the price. If the phone starts selling out, they'll increase the price, right? It's the same thing with the stock market. It's a tool to advertise price, right, and facilitate trading. Another example, right? If Apple is priced at 200, no one wants to buy it, right? Price will decrease. If Apple is priced at 100 and no one is selling, price will then increase, right? It's the same exact concept. This is the auction theory, right? This is the job of the stock market. If no one is transacting at a certain price point, the market must advertise itself at a different price point to get people to come in. And when I talk about smart money concepts, right, it's about the price level. So how do I find these price levels that smart money is into? So look at it like this, right? Even a 5-point move in the stock market takes hundreds of millions of dollars. So institutional traders make up 97.8% of the total market transaction, right? And this is how we know they're active, right? So retail traders only make up 2.2%. So, right, so it's why we stay away from retail strategies, chart patterns, candlestick patterns, lagging indicators. All that shit to me does not work. So we're just looking for big moves in the stock market. It's that simple. This is how I find my levels of interest, right? So I'm going to look for a significant move up or down. I'm going to be interested in the price zone right before the big move, right? These zones are where all the orders get filled, causing price to go crazy. So remember, big moves takes hundreds of millions of dollars. This is how we know where the smart money is sitting. So an issue with this that we use to our advantage is that big money has a huge problem, which is all to do with liquidity, right? There's two sides to every transaction, meaning when a whale, a big potential buyer or seller, wants to offload or enter a position, there must be someone on the other side buying or selling to them. So foreshadowing a little bit here, getting a little bit too ahead of ourselves, right? But this is where market manipulation and liquidity levels come into play that I actually take advantage of. Now, when it comes to volume, people get this all confused, right? There's no such thing as buy or sell volume. There's two sides to every transaction, so volume is just simply going to be volume. How I know who's in control, right, is I use the auction theory. So I need to use the bid and ask spread, order types, and the relationship between passive and aggressive participants. So it sounds confusing, but it's actually really complicated. It sounds complicated, but it's actually really, really simple. Bid versus the ask. The spread is the difference between the bid and ask price. The bid is the price that the buyer is willing to pay for an asset. The ask is the price the seller is willing to sell an asset for. So every stock, whatever it is, has a bid and ask price, right? For futures, they're pretty consistent and they're close together. Because futures have tight spreads, right? They're basically irrelevant. So buyers want to buy at a cheaper price, the bid, and sellers want to sell at a higher price, the ask. Quick example of the bid and ask on the right here, right? The buy button, right? The bid is at 5499.5 and the sell button, the ask, is at 5499.0, right? So the bid is cheaper than the ask and the ask is more expensive than the bid, right? That's how we know which ones are aggressive sellers versus aggressive buyers. Now, the order types are also super, super important. Right? We have the market orders, we have the limit orders, and then we have the stop, limit, / market orders. This is important to determine who is actually aggressive versus passive as well. But a market order basically is telling you that they're getting filled at the current price. You're being aggressive. You want to hop in right away, right now. Let's, imagine you're to a restaurant and you're looking at the menu and you see lobsters on there, but the price for them says market, right? It means whatever the price of lobster currently is, because it's always changing, fluctuating, is what you'll pay. Same thing with the stock market, right? Whenever you put in a market order, you want to get filled in for whatever the current price is at that moment. And it's constantly changing very, very fast. Now, limit orders are all the passive participants in the market. It's only filled, you only get filled where you put that order for, right? And it'll stay open until it gets filled or the market closes. So for example, if an investor wants to buy Apple at around $100, but Apple is currently trading at $110, he'll put a limit order to buy Apple at $100, right? And it will sit there until Apple either hits $100 and it gets filled or the market closes. Stop orders. This is how you manage your risk, right? And you'll place this after you're already in a position, right? It's required to manage risk properly. It's 100% required, right? So the investor bought Apple $100, but he found an invalidation level, right? Which is something I do differently than most people. An invalidation level at 90, right? So they'll put a stop order right below 90, meaning if Apple gets below 90, it will sell for them and close their position, so they don't have to be watching that 24/7. So how do you know who's in control, right? Now that we know the order types, the difference between the bid and the ask, we can use Orderflow to see who is in control, right? Who is aggressive? Remember, the aggressive players are the ones who are the market orders, right? When an investor buys a market order, it will hit the ask, right? They're buying at a higher price, hence they're being aggressive. So whenever a buyer is being aggressive, they'll put a market order in because they want to buy right now and they're willing to pay a higher price for it, aka the ask. And it's just the opposite. So when a seller sells, right, add a market order, say I'm in a position or I'm out of position, I want to go short and I sell, I want the bid because it's a market order, right? Whatever the price currently is what I'll sell for, right? They're selling at a cheaper price, right? Since they're being aggressive. They're willing to sell at a cheaper price and they're being aggressive. All the passive orders are all the limit orders sitting in the market, right? And they will only trade if price goes where they want it to be. These are the passive players and usually the big players as well. So the relationship between them is how we read who is in control, right? The market will move up if there's more passive buyers and aggressive sellers and vice versa. So if the buyers are in control, it means there's more aggressive buyers and passive sellers or more passive buyers and aggressive sellers. Sellers in control, all that means is there's more aggressive sellers and passive buyers or more passive sellers and aggressive buyers. I know it's confusing, but we'll get into the tools I use to read these that make it super, super simple. Also here, really quickly, going to jump into an intro to risk management before the next class, guys. Today is simple. I don't want it to get too crazy. So if you understood everything we talked about already, good. You're on a good path, right? You have to understand what this theory comes from before you can actually learn to trade it. So before we start trading, I want y'all to know an intro to risk management because it's super, super important. The next videos will have a more in-depth risk management strategy or how to use it, but let's just get into it really quickly because it's a huge part of trading. So we must know that the market does not care about how much money you're comfortable losing. It only cares about price. So for your personal account, a general rule of thumb is you don't want to risk less or more than 2% of your account in a single position. This does not mean that your position size has to be 2%. It means your stop loss level must be less than 2% of your account. I personally risk a lot less than that. So a quick example, if your account size is 10K, your risk size is $200 per position, right? You identified a long setup on the ES, invalidation level at 4990. So a quick test here, right? So if you enter one ES contract at 4491 or lower, 4 points of risk on one ES contract is $200, right? So that's where you need to enter because you identify your risk, right? 2% of the account is $200, meaning your stop loss has to be around $200. So if you enter in at this price right here, right, you must have your stop loss at this 490, which is invalidation. So that's why your entry will be adjustable. We'll get really deep into that soon, guys. So with prop firms, it's a little bit different, right? So it'll give you access to leverage, but your account size is basically your drawdown. We have a whole section on prop firms as well. So with the 50K account, you can have access to 50K in leverage, but you can only lose 2K before the account is blown. So risk management is personal, but based on your own, right? It'll be based on your own win rate and your own account size, which we'll be getting into it deeper in the next video. But just a quick little example. Prop firm, your account size is 50K, your drawdown is 2K, right? So a rule of thumb that I use to tell people what you should do with prop firms, because everybody's different. After 5 losing trades, you don't want to be below 50% of your drawdown, right? So your risk per position here can only actually be $200, not 2% of 50K. Your win rate is super important as well, right? This is how accurate each setup is. Not overall. I want to know exactly what a certain scenario happens that's super defined. What's the percentage chance of it actually going in your favor versus not. Once we know that number, we can use a risk to reward table to tell us exactly how much money we should risk before we get out. So let's say we're 50% accurate, right? That means all we need is a 2-to-1 to be accurate. Meaning every time my invalidation level is at $100, I must be aiming to make $200, right? And obviously it'll change depending on your win rate. Remember, trading is all based on probability and it's a long-term game. We never know what the market's going to do. It's completely unpredictable, right? The only thing we really know and the only thing we can control is the risk, right? So pro traders have slightly leaned probability in their favor, and all that's left for me to do now is manage my risk appropriately and stack up the money. Example I like to use is the magic coin flip, right? You can flip a coin 10, 20 times and it might all land on heads. You flip that coin 1,000 times, 2,000 times. It's going to be a close 50-50 shot. Every time you lose, you're losing $1, and every time you win, you're winning $2. The money will stack up in the end. All right, guys, that wraps up the video. So this is probably the most boring one and probably the shortest one as well. The next class we'll get into technical analysis and more risk management. And the third one, we're going to be talking about how I build my setups and how I build my entry triggers, guys. So stay tuned, subscribe, and make sure to pay attention for that next video.